Well, good morning and welcome to the Reserve Bank. With me, I've got John McDermott, who's the Chief Economist and Assistant Governor. And let me offer a special welcome to the students from Waikato Diocesan School, winners of the Monetary Policy Challenge amongst 64 high schools. And I see Emma has been appointed Governor, and if it gets too tough, Emma, well, you'll be up here with us. The Reserve Bank today reduced the official cash rate by 25 basis points to 2%. Global growth is below trend despite unprecedented levels of monetary stimulus. Considerable surplus capacity remains across most economies, and along with low commodity prices is suppressing global inflation. Some central banks have eased policy further since the June monetary policy statement, and long-term interest rates are at record lows. Weak global inflation and the upward pressure on our exchange rate is causing negative inflation in the tradable sector and making it difficult for the bank to meet its inflation objective. A decline in the exchange rate is needed. Domestic growth is expected to remain supported by strong inward migration, construction activity, tourism and accommodative monetary policy. However, low dairy prices are depressing incomes in the dairy sector and reducing farm spending and investment. House price inflation remains excessive and has become more broad-based across the regions, adding to concerns about financial stability. Annual CPI inflation is expected to weaken in the September quarter, reflecting lower fuel prices and cuts in ACC levies, but is expected to rise from the December quarter. Although long-term inflation expectations are well anchored at 2%, the sustained weakness in headline inflation risks further declines in inflation expectations. Monetary policy will continue to be accommodative, and our current projections and assumptions indicate that further policy easing will be required to ensure that future inflation settles near the middle of the target range. So happy to take questions.
Governor, I think it was 12 weeks or so ago you said you expected banks to pass on the last cut in full. Do you again expect banks to be passing on this cut?
I think I said I expect that most of the cuts will be passed on. I think that was my language at the time. I mean, it's a very competitive market, and we don't want to end up directing banks on pricing. But it's a complicated thing for the banks, I think. If you look at their net interest margins, they've been generally trending down since late 2014, and they're not out of line internationally. So that's on the net interest margins. If you look at what's happened to say 2 and 3 year fixed mortgage rates, and that's most of the lending is fixed mortgage rates these days. The reduction in 2 and 3 year fixed rates over the last couple of years, or at least since we've been lowering the OCR since June last year, the reduction in those 2 and 3 year fixed mortgage rates has been more than the OCR. So it's a complicated assessment. They'll need to think about their competitiveness, competition in the sector. They'll no doubt think about the net interest margin and the fact that it's been falling. Their offshore funding costs have been rising a bit. They will need to refinance their positions at times, and when they roll over that finance, they're likely to have more expensive funding. Then on the other hand, the additional point I should probably make is that if you look at their credit growth, it's been growing more rapidly than their deposit growth. So, they're going to be out there competing for term deposits, and that's going to require, one would think, over time, higher interest rates in order to attract those deposits, particularly as the OCR falls.
I get that it's complicated, but would you repeat your similar comment that they should pass on most of it?
We would like to see most of it passed on.
Two questions. One's a follow-up to that. Does that pass on include, I'm thinking particularly given your comments about attracting deposits, would you want to see that pass on included for deposit rates, particularly given that credit growth that's happening? Secondly, we'll deal with that one first. The second one is the second topic.
Well, it's up to the banks to work out what they want to do in terms of do they want lower lending rates, or do they want to attract more deposits through higher deposit rates. That's a judgment they'll need to make.
Yes, but I suppose from a macroeconomic point of view, would you like to see effectively more saving?
Well, it's not a view that it's not a position that the bank has. I mean, in essence, we're concerned for those people who are on fixed incomes and living off term deposits, and if that's their only source of income, then that's a concern. As interest rates fall, it's a concern internationally. You see it offshore, you see it here as well. But in the end, it's up to the banks to make those judgments.
Okay, second question. Did you give any consideration to doing a 50 basis point cut?
No serious consideration.
Why not?
Well, we didn't think it was justified. If you look at the economy, it's forecast to be growing at around 3.5% over the next 2 years. We've indicated that we do want to get back into the inflation target range. We want to head back towards the midpoint. We've indicated that based on our assumptions and judgments that underpin those forecasts, that we think further interest rate cuts are likely. And we've built into those projections 60 basis points of interest rate cuts. Now, time will tell whether we need more or whether we need less. But at this point, we didn't think we needed to go out with a 50 basis point cut.
So the ANZ has only passed on 5 basis points to its floating rate customers. Does that surprise and disappoint you in light of what you're saying that you'd expect them to pass on most?
Well, I've already commented, I think. It's up to the ANZ and it's up to the other banks to work out how they want to handle this in a competitive market.
The Kiwi was up by about a cent on the reaction to the news. Was that what you were expecting, that prices had been built in ahead of perhaps a 25 basis point cut?
We'd seen the OIS market and the way it was trending. But to be frank, nothing really surprises me too much in these global financial markets about reactions, either in terms of swap rates or exchange rates.
And your comments around the Kiwi that it needs to decline, have you given any consideration to intervening in the market? You haven't been using the language about it being unsustainably high or unjustifiably for quite some time.
We've got an intervention policy which is pretty well known, I think. It's a traffic light policy. Let me not comment further at this point about whether we're intervening or not.
Are you starting to feel that there's any point in continuing to call for the currency to fall, given that often immediately after you do, the currency actually rises?
Well, I think it's always difficult to predict what the exchange rate reactions might be, and let's see what happens over the next few days. If you recall, Governor Kuroda at the Bank of Japan introduced negative interest rates, and the exchange rate appreciated. So it's a massive market. Turnovers roughly on BIS figures about 105 billion US dollars a day. Most of that's traded in US dollars. Most of it's traded offshore. The actual spot and forward trades are probably about 40 billion US dollars a day. So how hedge funds position themselves and money market funds is really up to them. So what we can do is try and give clear messages about what our intent is with monetary policy, how we're reading the economy, and we've tried to give a pretty clear statement today about our future intentions if the projections that we've got hold together.
You've talked about a concern that long-term inflation expectations could fall further and become unanchored from the midpoint. Does there come a point at which you actually have to decide that they are unanchored from the midpoint and the midpoint needs to change?
Well, I'll get John to add some points on it, but you know, if you look at long-term inflation expectations, they seem to be well anchored at around 2%. What we have seen is a fall in short-term inflation expectations, and we saw a quite significant fall in short-term inflation expectations in March, and that's why we cut the OCR in March. So we would be concerned to see further falls in short-term inflation expectations. The worry would be that that inflation expectations are largely adaptive, and by that I mean that outcomes in terms of headline inflation, if that's low, and it has been very low as we all know, largely driven by the negative tradables inflation for the last 4 years, if that led to a result where inflation expectations were starting to fall further, then that would be a concern for us. John, did you want to add things?
A couple of points to emphasise. Inflation expectations tend to move very slowly following outcomes of inflation, but the longer inflation is away from the target, the bigger the risk is, and the bigger the risk, the bank has to respond even stronger. You mentioned in the question, and other people have mentioned this, should you adjust the target in response? That's probably not going to do much because, again, the evidence is that when New Zealand has moved its target, and it's done so on a number of occasions in the past, all that you do is immediately alter inflation expectations down to the new level, so you achieve nothing.
Sometimes see comment in the media and by other commentators saying, look, inflation targeting is dead. But if you look around, or 30 central banks that have said, in no case that I'm aware of has any central bank moved away from that framework. Most of them have inflation targets of 2%. If you look at the Federal Reserve, their policy target in terms of their consumer price deflator, well, their private expenditure deflator, in fact, is 2%. Bank of Japan's 2%, Bank of England's 2%, the ECB is just below 2%. None of those central banks that have been inflation targeters have changed their framework and moved away to another policy framework. And I don't think there's any, although I could be mistaken, I'm not aware of any central bank that's reduced its inflation target. The problem we have is that by and large we have virtually no influence over tradables inflation. And tradables inflation accounts for roughly 50% of the CPI. So it's been negative now for 4 years. And, you know, why has it been negative? Well, overseas inflation rates have been very low. We obviously have no influence over that. There's a global oversupply of manufactured goods. There's a global oversupply of capital goods. We know what's happening to information technology costs. We know what's happening to commodity prices. We have absolutely no influence over any of that. And we have very limited influence over the exchange rate, as I've just mentioned. The thing that we can control to some degree is non-tradables inflation. And that accounts for roughly 50% of the CPI or thereabouts. And that's been tracking somewhere between 1.5% and 2.5%. So it's pretty well along the lines of what we've expected. We've seen a bit of wage moderation, more than we anticipated, and I think a lot of that is due to the growth in the labour force and particularly the strong migration inflows that we've been having. And we've also seen some government charges like ACC cuts, which have lowered non-tradables inflation. So where we are is we can't do much about tradables inflation. We can have quite a degree of influence outside of government charges. We can have quite a degree of influence on non-tradables inflation, and that's been running roughly between 1.5% and 2.5%.
Just on the immigration issue, you called for a review of immigration policies, I think, in the recently. Do you still want to see that, and do you think a cut in immigration numbers would get some of that wage growth that you're looking for?
I think the key issue around migration is what is the, for want of a better word, the quality of the people that we bring in. I'm not talking about returning New Zealanders and excuse me, things like that. But what are the skills that we're bringing in, and can they add value to the economy, and are they getting employed? And if the answer to that is yes, we are bringing in high skills and they are going into the labour force and getting employed, then I think that's a good thing. So the issue is really around what's the quality of the people that we're bringing in. Now, what we have seen is such strong migration flows, which is a combination of people returning to New Zealand and fewer people leaving, that it's been running in terms of working age population at about 60,000 a year or thereabouts. So since the end of 2012, something like 160,000 people have come into the country in that sense, or in terms of net migration flows. And that's about 4% of the labour force, and that's added, some downward pressure on wage outcomes in terms of the expansion in the labour supply, and clearly it's added quite a lot of pressure into the housing market as well. Did you want to add anything, John?
So if non-tradable inflation is really the only thing that you can have significant impact on, and it's running at more or less 2%, between 1.5% and 2.5%, and cutting the OCR doesn't have any impact on the exchange rate, but does presumably have some stimulatory impact, why keep cutting?
Well, in essence, there's two things. I think those who say, look, you've got an economy that's growing quite nicely here in many respects. Don't cut interest rates. I think one of the challenges there is that you're going to see further upward pressure on the exchange rate. If the interest rate differentials between us and the rest of the world, and since June you've seen the Bank of Japan ease, you've seen the RBA ease, you've seen the Bank of England ease. So if those interest rate differentials widen, I think you're going to see upward pressure on the exchange rate, and that's going to hurt the tradable sector of the economy. It's also going to mean that headline inflation is going to be lower. And then you run the risk of inflation expectations becoming unstable, particularly at the short end, and does that start feeding through into the longer end? And that would be problematic for us. Did you want to add anything, John?
Well, only repeating and emphasising the point and the risks around inflation expectations, we do need to guard against them falling, and failing to do so would be a bigger problem in the future.
You said you never considered a 50 basis point cut. Was one of the reasons for ruling that out the fact that the Auckland housing market took off again this year? In other words, if the housing market hadn't taken off, would you perhaps have been more open to considering a bigger cut?
You know, I think if you know, we were in a different situation, but it would have to be a dramatically different situation. I mean, we're in the most, I think, extraordinary financial market situation globally that the world has seen for decades, and maybe even beyond that, possibly even ever. I mean, to have a situation where countries that represent 2/3 of world output have interest rates either 0.5% or below, or countries that have negative policy rates now account for 1/4 of world output. And you're seeing more quantitative easing this year likely to be taking place, given what you're seeing with the Bank of England, the Bank of Japan, and the ECB. If you add it all up, it adds up to about 150 billion of quantitative easing a month. So these are just phenomenal circumstances that we're operating in. But if we were in a normal global economic cycle and we had an economy that wasn't captured by all that, and you did see housing markets doing this, then you would be trying to raise interest rates in a normal situation. But that's quite different from where we are. So we've introduced macroprudential policy. As you know, we've adjusted the LVRs just recently. That was done for financial stability purposes to try and reduce the financial risks around the housing market.
Yeah, on that, have you made any more progress on the debt-to-income ratios? Has there been any progress with the government in terms of getting them to include that in your MOU?
We've talked with the Minister of Finance. We're engaging with the Treasury. We've been talking to bank chief executives. We're likely to report to the Minister probably in the next week or two, seeking to get the DTI, the debt-to-income ratios, as a macroprudential instrument. We've talked, as I say, with the banks. They're very keen to work with us on the concept. I think it's probably likely that we shouldn't expect to see anything this year, but we are doing work on it, and as I say, we will be working with the banks.
Governor, how long do you wait to see a depreciation in the currency? I'm just thinking about the alternative scenario that you've got if the exchange rate doesn't moderate and you've got the forecast track for the 90-day going even deeper than your central forecast.
Well, as I say, a lot of things drive exchange rates, even though you might be closing interest rate differentials. You also may see the exchange rate move adversely relative to the terms of trade. So, as I say, it's not a thing that we have huge influence over. But we've got projections of cutting rates for two main reasons. We do want to take the pressure off the currency if we can, and we would like to see it fall. But secondly, we are concerned about this negative tradables inflation and the impact that it may have on measured inflation going forward, and whether that starts to unseat the inflation expectations.
I mean, how long does it take before you look at your central projection and go, right, what we've done here, and presumably if you go again in the foreseeable future and it still doesn't make any headway, I mean, how much longer do you then wait to go, well, do we need to go even further?
Well, that's something that we'll be discussing internally if we get into that situation. We come back with OCR decisions every 6 weeks. And as you know, every 3 months we do a pretty comprehensive review of forecasts and projections.
So can we just be clear about what you'll do to keep inflation expectations up in terms of monetary policy? Is it ultimately whatever it takes to ensure that they stay up, and if that requires cutting the OCR close to zero, would you be prepared to do that?
Well, let's just see how the future unfolds. One of the things that you've seen is central banks have gone towards zero and below zero. As I say, there's central banks that in countries that now account for a quarter of world output have negative interest rates. One of the things that they need to think about is what are their degrees of flexibility for further monetary accommodation in those countries if you run out of room, and what happens if you've got an adverse shock or the global economy slowed. So, we take all sorts of things into our judgments in thinking about the interest rate outlook. As I say, we are inflation targeters. We're flexible inflation targeters. There's flexibility in the PTA, and I talked about that in a speech back in February about that degree of flexibility. But we do make judgments, trying to get inflation back into the band and towards the midpoint over time. Did you want to add anything, John?
Again, emphasising, we still have a mandate to achieve, but there is some discretion about how long is appropriate. So you want to get back to 2%, but you don't want to do it in a way that's going to cause further damage to the New Zealand economy, and that's very important.
Well, thanks very much indeed.